Hi, good afternoon, ladies and gentlemen. My name is Amay from Marcom team of India Ratings and Research. I welcome you all to this webinar on 1HFY24 rating performance. Kindly note, all participants' line will be in listen-only mode. However, you can type in your queries in the Q&A section. I'm delighted to welcome our panelists for today's discussion, Mr. Vishal Kotecha, Director and Head Infrastructure at India Ratings and Research, Mr. Karan Gupta, Director Financial Institutions, India Ratings and Research, Mr. Prashant Tarwadi, Director Large Corporates, India Ratings and Research, and Bharat Ramji, Director of Mid Corporate, India Ratings and Research. We have today's presenter will be Suparna Banerjee, Associate Director, Credit Policy Group, India Ratings and Research. I also warmly welcome moderator for the session, Mr. Arvind Rao, Senior Director, Credit Policy Group, India Ratings and Research. I request Arvind sir to set the context and take the discussion forward. Thank you, and over to you, Arvind ji.
Thank you, Amin. Good afternoon and welcome all to the presentation on ratings performance during the first half of financial year 24. We had today published the report titled Corporate Credit Profile, that is financial year of FY24, first half of financial year FY24. The credit ratings performance during this particular period has been robust, but we have also seen some amount of moderation. After an exceptional year of performance in FY23, which was amidst the kind of macroeconomic challenges that we had seen, the domestic credit profile had been resilient. And in the first 6 months of the current financial year, there has been no shocks that we have seen, and we have seen that the macroeconomic conditions have been on a gradual mend. Unlike the last 3 years where there has been one or the other issue, this year has been a fairly benign 6 months, though there have been challenges that were there, and these did not, however, impact the credit profile of the rated entities. In terms of the performance, the global GDP is expected to grow at about 2.5%. This is against what was projected at about 1.4% at some time during the beginning of the year. Domestic GDP is also expected to remain robust at about 6.2%. India Ratings in-house economists are pegging it at 6.2%, and this has increased from the earlier estimates of below 6%. For the last 2 years in a row, rating upgrades have significantly been higher than that of the downgrades. Prior to the 2 years, that is between 2019 and 2021, the downgrade to upgrade ratio has been above 1, indicating that the downgrades had outpaced upgrades, with FY20 being at the highest level of 1.7. In FY22 and FY23 is where we saw the reversal of trend, and we had seen one of the lowest levels of downgrade to upgrade ratio at about 0.3. After 2 years of continuous high upgrade intensity, we see that continuing into the third year with the upgrade intensity marginally deteriorating, but it nevertheless continues to remain robust. As per the title of this particular report and the presentation, we are seeing signs of moderation, which we had commented in our last year's report, and that has played out. In terms of the rating actions for the year so far, that is the first 6 months, we have seen about 146 ratings getting upgraded, which represents 17% of our reviewed portfolio, while we had seen about 55 issues being downgraded. The corporate downgrade to upgrade ratio has remained low at 0.38, as I had said earlier, compared to 0.26 in FY23 and marginally lower in the first half of FY23 at 0.25. Defaults have remained steady at 0.8% of the cooperative reviewed ratings, and we are talking about all the ratings that have been downgraded to D. And most of these downgrades we have seen coming from sub-investment grade, or rather all the ratings that have been downgraded today have been coming from sub-investment grade. The 0.8% is significant because we have seen this remaining at this particular level for some time now. In terms of the corporate credit performance, as I mentioned earlier, the intensity of upgrades has moderated, and the intensity of downgrades have increased marginally. There has been no major change in this particular mix. However, within the upgrades, if we see the manufacturing and service corporates, there we have seen a slowdown in the upgrade proportion compared to what we had seen earlier. The downgrade to upgrade ratio for manufacturing and service corporates is now at about 0.45, which is double of what we saw at 0.22 last year. Infrastructure and financial corporates have largely maintained their rating intensity. Let me hand over the floor to my colleague Suparna for a presentation that will take you through the detailed analysis of the rating actions. Over the next 15 to 20 minutes, Suparna will explain how corporate credit profile behaved in the first half of FY24 with focus on rating actions, that is upgrades, downgrades, and we'll also be talking about the rating reaffirmations. Suparna will also look at the reasons that led to the rating actions, which sectors fared well and which did not. After the presentation, we'll get on to a second interesting topic of the day, which is the panel discussion. We'll get detailed insights from the experts who have the ringside view, because they meet the issues that where we have seen the rating actions. They are the analysts on these cases and are the committee chairs on these sort of rating actions. So what we'll do is, from these panelists, we'll hear the key takeaways for the first half of FY24 rating actions, and what do they foresee for the coming 6 months of FY24. Over to you, Suparna.
Thank you. Good afternoon, ladies and gentlemen. Before I start, I want to mention that through the course of the presentation, for the numbers as well as the ratios that are quoted for the first half of FY24, these are only for those issuers who have been cooperative during the period and exclude withdrawn and non-cooperative issuers. The reason non-cooperative issuers have been excluded is because generally there is either very limited or no information available for these issuers, and hence do not show the true picture, and they are also not reflective of the ability of India Ratings to really analyze these ratings. Secondly, in certain graphs, we are going to mention directional indicators, that is positive or negative directional indicators. And the reason is that generally ratings have an outlook which could be positive, stable, or negative. And the reason for including the directional indicators in our analysis is because these outlooks also provide an indication of possible movements of the rating portfolio in the near to medium term. So with this background, I'll start my presentation. I'm sharing my screen. I'll be talking first about the rating, the portfolio highlights. This is the representation of India Ratings rating universe, and the chart on the left shows the distribution of the ratings based on overall cooperative ratings and structured finance rating as on 1st of April of each year. India Ratings model rating have transitioned to India Rating BBB in April 2018 and remained so at the beginning of April 2023 as well. As of April 2023, 85% of India's ratings, overall cooperative ratings, were in the investment grade compared to 80% as of April 2022. Coming to the graph on the right side, this is the rating distribution of the reviewed portfolio for the first half of 2023 as well as 2022. And as of September 2023, about 80.5% of the ratings were in the investment grade. This excludes the structured finance ratings versus 85% as of September 2022. Coming on to what really happened in the first half of FY24. So as Arvind mentioned, FY24 commenced with the global macroeconomic challenges, basically on the back of the Russia-Ukraine war, multi-decade high inflation and tighter financial conditions. On the domestic front, demand growth showed signs of normalizing. Exports were seeing some slowdown from the global headwinds. This can be clearly seen from the chart that is in the half-yearly rating distribution. If we see the first half of FY23, rating upgrades were on the upswing, with 25% of the reviewed portfolio getting upgraded. However, we saw some sequential slowdown or moderation of the rating upgrades. That can be seen at the second half of FY23, we saw 18% of the ratings being upgraded. And in the first half of FY24, that is the current period, this further moderated to 17%. However, we'll notice that although the rating upgrade moderated, it continued to significantly outpace the amount of downgrades. So the downgrades were only at 7% of the reviewed portfolio. Now, what supported this rating upgrades is basically the financial discipline by the corporates. This was backed by private consumption-led demand, especially in the premium products, government-led investments, and strong services. Also, soft commodity prices started supporting the margins. Overall, India rating upgraded a total of 146 issuers versus 55 downgrades. As Arvind had mentioned, the corporate downgrade to upgrade ratio remained low at 0.38, although it slightly inched up versus 0.26 in FY23 and 0.25 in the first half of FY23. Defaults remained low at 0.8%. However, it was stable throughout the year and as per last year as well. All the defaults were previously rated in the sub-investment grade rating category. And the reasons for the default of these entities were mostly individual issuer specific, which resulted in the liquidity crunch. Coming to rating category-wise volatility, so high rating categories have traditionally shown more stability, while vulnerable sub-investment grade have remained volatile. However, for the first half of FY24, we can see that AA category exhibited higher volatility. This was mainly because of two counts. First is rating upgrades were seen in 21 ratings belonging to two obligor co-obligor group, and on the other side, downgrades were seen in 4 entities with linked ratings. However, BB category and lower continue to see higher rating downgrades, with 10% of the ratings being downgraded. Overall, the downgrade rate for 1HFY24 was at 7% and upgrades were at 17%. Coming to group-wise rating actions, so large corporates upgrade intensity half to 11%, which was 22% in the first half of last year. And this was mainly on the back of a strong upgrade momentum, which was seen in the last 2 years. However, downgrades tripled to 7% for large corporates. And however, point to note is that majority of the downgraded entities already carried a negative directional indicator. The mid corporates, which are largely entities in the BBB and BB categories, these continue to sustain a high upgrade, with more than 20% being upgraded this period as well. This was more to do on the track record of sustaining improved credit profile, supporting their rating actions. Infrastructure companies continue to account for a large amount of upgrades, as can be seen from the graphs. For the first half, 1 quarter of the upgrades were from the infrastructure sector. On the other hand, financial sector continued to have high stability. More than 90% of the ratings were affirmed. Going forward, there will be likely moderation in rating movements, which we'll talk about later in the presentation. Now, the key rating reasons, first on the upgrades. So improvement in revenues and operating performance were the two major reasons for the operating of the upgrades. And improvement in the revenue profile was the largest reason. This was mainly to do with a spurt in demand for existing products, or higher execution of projects, or higher execution of order book amid demand recovery, or higher realizations or contribution from launch of new products, or maybe additional facilities coming on board. This could be largely seen in sectors such as auto components, capital goods, construction sector, where large and well-established companies rated in the investment grade categories had the ability and the flexibility to pick up the strong demand. The other major reason for upgrade was operating performance. Here, improved product mix or improvement in order book, successful completion of Capex plans, especially in the power sector, or capacities coming online, were the main reason which led to better than expected performance in the operations. Now, the key downgrade reasons. This was mainly due to a deterioration in financial metrics and liquidity mismatches. And nearly half of the issuers which were downgraded were already on a negative directional indicator. More than 25% of the downgrades were due to weakening in financial metrics. This was led largely by larger than expected support given to group companies, and not due to any operational performance related factors. Also, in terms of liquidity, which was the second largest reason for downgrades, these were not due to any systemic disruptions, but were largely from entity-specific issues. The other reasons which were the key drivers for the downgrades were weaker than expected operating performance and pressure on profitability. Now, on the financial performance of the reviewed portfolio. So the financial performance continues to complement the rating movements. This can be seen in both the graphs, the revenue trend and the trend in financial metrics. In both the graph, the dark blue lines represent the upgraded issuers. As we can see, whether it's in the revenue trend or in the financial metrics, the dark blue lines continue to outperform the reviewed portfolio. And the other extreme is the light blue line, which represents the downgraded issuers. These issuers, as can be seen from both the trends, they continue to underperform the overall portfolio. Talking about year-on-year, so year-on-year revenue growth is expected to moderate to around 15% for FY24. This was expected to be 16% for FY23. However, the moderation comes after witnessing a buoyant performance in FY22. Net leverage of reviewed rating is expected to be largely flat at around 2.23x during FY24. Arvind did speak about mid-sized corporates. So at the beginning of FY23 and the end of FY23, we had seen that mid-sized corporates were catching up with the overall performance of large corporates. What we see in terms of trends is that in 1H of FY24, mid-corporates seem to have caught up with it. So we have seen that the mid-sized corporates have witnessed healthy revenue growth during FY23 at around 20%. In fact, in terms of FY24, the median revenue growth is expected to improve to 16% for mid-sized corporates compared to 10% for large corporates across the reviewed corporate issuers. However, if you have to talk in terms of interest coverage, large corporates are better placed in terms of interest coverage as compared to their mid-sized peers. And while coverage for mid-corporate is expected to improve in FY24 despite the rise in interest expense. Overall, although Capex spends are expected to see an uptick, however, net leverage is expected to remain low across the corporates in FY23 and 24. I'll be talking about the key industry performance right now. So this graph is a representation or a sector heat map where we have converged the top industries along with the reasons for the actions that have taken place. For example, you can see that power had one of the largest upgrades, and one of the largest reasons for the upgrades in power has been operating performance. We have already talked about the key reasons for the upgrades or the downgrades. Now we'll be talking about individual sectors in details. Overall, we can see that positive rating actions have been seen across sectors. The first graph, the top graph, represents the top industry trends, and we can see that the line graphs in the color of green and pink have been seen across sectors. This was mainly driven by an improvement in the overall business performance, leading to significant revenue visibility while maintaining sound financial metrics. Corporates continue to reap benefits of lower debt levels and improve profitability, thereby providing adequate headroom to navigate through the ongoing macroeconomic situation. What also supported the issuers was premiumization of consumption. Around 17% of the review ratings were upgraded and 7% was downgraded. However, also important to note is that more than 76% of the reviewed ratings were affirmed. This was higher than last the same period of about 69%. The top affirmed sectors were oil and gas and financial services. Now, talking about individual sectors. So, power sector saw the highest number of upgrades, and especially in the renewable power segment. This was supported by improving operating performance, successful completion of Capex plans, and presence of a new strong sponsor. Conventional power generation and transmission sectors were driven, the upgrades were driven by successful project commissioning. There were some downgrades mainly limited in wind power and hydropower, and they were due to individual weakening in operational performances. The second chart is the outlook distribution. As we can see that the rated portfolio is largely on a stable outlook. And the last chart shows the distribution, the rating distribution of the reviewed ratings. And we can see that the reviewed portfolio is in high investment grade category. The next sector I'll talk about is auto and auto components. So around 45% of the reviewed auto and auto components issuers saw positive rating actions. The issuers benefited from a large order book amid a recovery in the domestic auto industry, as well as the global China Plus One strategy. This provided better revenue visibility as well as higher realizations from better margins, leading to improved profitability as well as financial ratios. The sector continues to be supported by continued domestic demand, low input prices, and abating concerns on supply of semiconductor chips. However, it is partially constrained by subdued export demand amid the macroeconomic headwinds. The rated portfolio is largely on a stable outlook, and the portfolio rating is in the investment grade category. Next sector is capital goods. So a third of the reviewed capital goods saw positive directions in their ratings. The issuers mainly benefited from a strong order outlook, better realizations leading to improved liquidity and thereby financial metrics. There were some negative actions seen in this particular sector, but these were largely those issuers which were unable to pass on the increase in input cost or had undertaken large debt-funded acquisitions or Capex, which had led to deterioration in financial metrics. The rated portfolio is largely on a stable outlook, and the reviewed rating portfolio is in the investment grade category. Next is realty. So realty upgrades were largely seen from a previous A- and above rated issuers, and the issuers benefited from better than expected pre-sales or healthy occupancy levels, which in turn led to improved liquidity and thereby healthier financial metrics. Negative rating actions were very minimal. They were more issuer specific and were largely led due to delay in either getting clearances on or due to some project delays. The rated portfolio is largely on stable outlook, and the reviewed portfolio is in a high investment grade category. I'll be talking about financial sector next. So financial sector showed high stability in the ratings. I mentioned already that more than 90% of the ratings were affirmed. Also, there were no downgrades in this particular sector. What benefited financial sector was the strengthening of balance sheets and an improving credit demand outlook, especially from working capital. Legacy asset quality concerns had waned. There was a shift in borrowings from debt securities and foreign currency market with continued sound capital buffers. Going forward, despite the increasing deposit rates and tightening of system liquidity, banking sector is expected to remain robust. However, NBFCs may face some margin pressure. The rated portfolio is largely on a stable outlook, and the reviewed portfolio distribution is in the high investment grade category. India Rating forecasts the banking sector credit growth of around 13.5% year-on-year in FY24 versus 15% in FY23. Talking next on the sectors that did not do well. So for construction issuers, about a quarter of the reviewed issuers saw negative rating actions. And this was mainly due to high raw material prices or significant increase in competition, especially in the road sector, which led to squeeze in margins. And this was mainly seen in smaller sub-investment grade issuers who were unable to absorb this higher cost. Also, if you look at the outlook distribution, nearly 20% of the reviewed portfolios on a negative directional indicator. However, the reviewed portfolios in the investment grade category. Next two sectors which were impacted were textiles and consumer services. In textiles, the issuer downgrades were driven by inability to pass on increase in raw material price or deterioration in financial metrics. More than 20% of the issuers are on a negative outlook, and if you look at the rating distribution, about 50% of half of the portfolio is in the sub-investment grade category. For consumer services, the downgrades were driven due to weakening of liquidity profile and incremental debt extended to group companies, which in turn led to pressure on liquidity. The portfolio generally on a stable outlook and consists of mainly investment grade category issuers. Now, what to expect next in terms of outlook? So we have looked at the outlook distribution of the reviewed portfolio, and we can see that 80% of the ratings are on a stable outlook, indicating that the entities are likely to sustain their credit profiles and have sufficient headroom. However, also to note is that around 10% of the ratings are on a negative directional indicator, and this is up from 8% from a year ago, indicative of India Ratings' cautious view on corporate credit profile for the rest of FY24. So what should we expect for the rest of FY24? Arvind has already mentioned that Fitch Rating has raised the global outlook for FY23 from 2.5 to 2%. And domestic market seems to be largely insulated from these global weaknesses. The upcoming private Capex cycle, while necessary, may start impacting the credit profile amid the elevated interest rate regime. Availability of funding is not seen as an immediate threat, even though systemic liquidity is low. Financial institutions do have a cleaner balance sheet and are likely to support the borrowing requirements of corporates. In short, I would like to conclude by saying that we expect rating actions to moderate for the rest of the FY24. That's it from me. Thank you, Arvind. Over to you.
Yeah, thank you, Suparna. That was an insightful presentation on the performance of India Ratings rated entities for the 6 months that has gone by. The gains in the credit profile made during the pandemic has continued to have excellent mileage, and with the economy performing strongly, we believe that the credit profiles are likely to sustain. However, as we have in our title and as we have seen in the presentation, there is likely moderation in the upgrades. Reaffirmations of the rating will likely to be seen at a higher proportion than what we have seen so far. which is what we'll be discussing in today's panel. Sorry. Before I start, I would request the participants to put up their questions in the Q&A box, and we'll take them up at an appropriate time. What we'll be discussing in today's panel discussion are broadly three parts, as I had mentioned earlier. The review of the rating actions that have gone by in the first 6 months of the current financial year. We'll also discuss on specific issues that we had seen impacting or driving the credit profile, and a sense on what is expected for the rest of the year. Our panelists have been introduced already, so without taking further time, my first question will be to Prashant, who is from the large corporates rating team. Prashant, as you have seen in the presentation, the large corporates have seen drop in the upgrade rating intensity, and while the downgrade to upgrade ratio was 0.1 1 year ago, we have seen that increase to 0.6. While it's still healthy, if I look at the way the rating movement has happened during this particular year, and if I add up the downgrade plus the negative directional indicator movement and compare it with upgrade and positive directional indicator movement, it's close to 1. We had seen this happen last 6 months of the last financial year also, where we had started seeing the rating actions kind of tapering, and we had seen more of stable ratings coming in for the large corporates. The assessment has been that since the time of COVID and the improvement in credit profiles that we have seen, this was easily visible in the large corporates, and hence the rating actions were seen to have happened in the large corporate space right at the beginning, as the ability to visualize these sort of changes are better for large corporates. So what did your view on the rating actions of the first 6 months of FY24, given the kind of background what we have seen, and given the moderation in the upgrades that we have seen?
Sure, thanks. Thanks, Arvind. I think firstly, as you rightly pointed out, decrease in the upgrade intensity. As you rightly pointed out, I think last year, first half, we were, the upgrade to downgrade was 3.25, which is, again, includes the positive indicator numbers as well. That number is close to 1 as we speak. It has moderated. The way to look at it is predominantly due to the base effect. As you rightly pointed out, immediately after COVID, we had taken a lot of rating action predominantly through Outlook route to factor in the uncertainty because of that unfortunate pandemic event. After the COVID, we have seen a very robust recovery. I think barring 1 or 2 sectors like they are into deep discretionary, we have seen barring all the other sectors have recovered back to pre-COVID level. There is a very strong growth in 1 or 2 sectors, technically in the critical infra cyclical. For example, auto has shown a very strong recovery, better than our expectation, and those numbers are getting reflected in the rating actions. So I would say those upgrade to downgrade ratios are probably because of the base effect. In terms of corporate credit strength, what we remain very positive. The corporate credit profile that we are seeing, it's the best of last decade that we have seen. If you see any indicator like net debt to EBITDA, which is at 1.3 times, which is lowest in last 1 decade. If you look at the cash flow that they are generating, even if the working capital side, from FY21, there is almost 6 to 9 days reduction in the overall working capital, which has happened in FY23. So overall speaking, the corporate credit profile is extremely robust. Just to again put things to the perspective, just to summarize, I think most of these we remain very positive on the overall recovery in the corporate credit, and this ratio is more to do with the base effect. And specifically on the rating action which has happened, I think there is no clear-cut trend that we have seen. Mostly the negative rating action has happened because of the commodity price environment, where because of the some of the commodity chemicals or some of the some of the weakness in the export market led to the commoditized nature of the industry, and there was a substantial reduction in their overall profitability. So, and somewhere it is liquidity mismanagement, and expansion plans backfiring because their funding was not in place, and the liquidity mismanagement. But most of these downgrades are more of a specific case by case basis rather than any broad trend basis.
Okay. From Prashant, let's move to Bharat, who looks after the mid-corporate rating space. And we had made a comment last year, Bharat, that the mid-corporate seems to be catching up with the large corporates. And typically mid-corporates are rated in the BBB and BB rated space. If we see the rating actions in the current 6 months of the current financial year, we have seen that they have maintained their momentum in terms of upgrades at about 20% of the reviewed ratings. Downgrades have marginally increased, but that is not too different from what we had seen even in the last 1 year. The way Prashant addressed in terms of the credit profile improvement translating immediately to the large corporates. What we understand is that mid corporates, we need to see a little more track record before we can translate that improvement in credit profile to the upgrades, because they are more volatile in nature. So, two questions. Are we seeing a track record building up and hence the upgrade proportion remaining steady when compared to what was witnessed by the large corporates? As explained by Prashant, is that one of the things that will be a takeaway? And second, in terms of the main reasons of rating action, how do you see this playing on going forward? Do you see moderation in the rating action similar to what we saw for large corporates, or do you see mid corporates continuing to enjoy a higher proportion of rating upgrade intensity? Bharat? Bharat, yeah.
Yeah. As you rightly pointed out, mid-corporate ratings kind of lag large corporate ratings. One of the main reasons being we tend to give benefit of doubt to the ratings only when we actually see a track record. While that has resulted in ratings actually being upgraded quite a bit on the mid-corporate side. There are two ways to look at this. At the lower end of the spectrum, at the Bs and BB category, it is more driven by liquidity. And at that side, the availability of COVID loans still on the books of the borrowers have resulted in some bit of liquidity, and hence that could have probably resulted in more than adequate liquidity and resulting in a bit of upgrades. While on the other side, if you look at the BBBs and the other rating categories, the auto ancillary bit is the sectors of auto ancillary and certain bit of EPC sectors have also done well. So these have actually benefited in the ratings of the mid corporates going as we look at it going forward. In as far as the downside is concerned, textiles is the sector that has seen the export markets not performing as well as we had anticipated. But going forward, given the rating stability being at about 70 to 77%, so we do see a bit of moderation as far as upgrades are concerned, especially given the fact that we do lag in terms of the corporate ratings are concerned. So from that point of view, we do see a bit of moderation in rating actions. While this time around, there has been a catch up as far as large corporates are.
Right. So, Bharat, I think one of the aspects which we had also looked at last year was whether availability of liquidity and what will be the impact of this particular parameter on the ratings. So, what we can do is we can park the question to our FI group expert to find out how is the liquidity available and is funding available, or are they seeing challenges to fund the mid corporates? What I'll do is I'll move on to Vishal, similar sort of a question, just to get a sense on what is happening to the rating actions. And Vishal, my question is in two parts. Over the last 1.5 years or so, we have seen that the amount of rating upgrades in the portfolio has been really strong. And this is to the tune of almost about 28 to 30% of all the reviewed ratings getting upgraded. And if I look at the current year, a fifth of all the rating upgrades are coming from the SPV operating in particularly the solar sector. If I look at your within the portfolio, they actually contributed to a large number, as large as 80% of all the rating upgrades. It was the same sector that contributed to the upgrade also last year. So, wanted to get a perspective from you. Do you see solar sector upgrades continuing going ahead also, or will they kind of taper off from now onwards, and we'll see more stable rating in infra space? The second question is related to the wind energy, which contributed to large number of rating downgrades last year. However, when I look at rating downgrades this year, there's no discernible trend, and most of the rating downgrades seems to have been linked to some sort of a linkage issue with the parent or the sponsor entity. So, wanted to get a perspective from you on these two aspects, and on your on the portfolio of ratings of infrastructure as a whole.
Thanks, Arvind. So, firstly, on the solar side of business, generally rating upgrades that we see, there are probably three broad buckets of reasons why, when we see rating actions. One is, sorry, hello.
Yeah. Go ahead, Vishal.
Yeah. So, three broad buckets is when we see. One is when the project is got completed and there's a ramp up of the generation which happens. There's a track record of generation happens. So, as a normal, normal rating would get upgraded as the project becomes more mature. Is when the ratings are getting upgraded. So that is one of the reasons. The second reason is primarily on account of consolidation. So stronger sponsors taking over projects from weaker sponsors, hence the ratings are getting benefited of the stronger sponsors. And we see consolidation happening over the last couple of years, and the trend to continue as well. And the stronger sponsors are buying more assets, and the plans are likely to continue. And the third reason is on account of operational performance. So what we also see on the solar side of businesses, once the project is operational, you tend to reach a P90 sort of a number, and then the numbers inch up higher to P75, P50 once the efficiencies and once the project is far more stable. Also, what has happened from a policy perspective last year, as we also pointed out during our outlooks, and also we had put out a wire in our webinar last year, was in regards to the change in with regards to the LPS policy, the late payment surcharge, wherein the payments from the discounts are coming in far more regularly. While the policy was implemented, somewhere in the middle of last year, we wanted to see a track record of how things are happening, and we are seeing that the track record has been phenomenal. And irrespective of the discounts, the payments are coming in within the timely manner of less than payment. So my receivable cycle is significantly squeezed, which has helped better liquidity and more certainty of cash flows, which have benefited the ratings. So that is largely on how solar portfolio has moved. And what we have seen in our portfolio is couple of, as Supana mentioned, couple of obligor groups which have seen a significant amount of upgrades. One on account of operational reasons and other on account of consolidation. So, that largely accounts for, say, 90% of the upgrades on the solar side. On the wind side, wind has been, the performance has been really off as compared to the P90 estimates over the last few years. And hence, we have been bringing, we have been probably bringing down the wind portfolio. Largely, what we have seen is, we tend to differentiate significantly when there is a wind project as against a solar project. And all the, the ratings largely account for a lower generation estimates itself now. And hence you'll see the moderation in the, downgrades. On top of it, the LPS scheme is also applicable for the wind. So that has acted as a positive. So the liquidity of the wind assets has been better off. So that has largely been the trend in the solar and the wind side.
Okay, thanks, Vishal. Karan, the entities that you rate fund the corporates and the infra. So if I look at, Suparna did mention that a good proportion to the extent of 90% of the ratings had been reaffirmed. When I look at last year and compare to what happened this year, last year the upgrades were slightly higher and there were a couple of downgrades. This year, while it has fallen marginally to about 9% of the rated portfolio, there seem to be no downgrades. And also, if I look at the directional indicators, about 9% of the ratings are on a positive outlook. The other thing that we have noticed is last time of the rating actions, we had seen a large number of rating actions coming from the AA category. At least a quarter of them were from a AA category. This year, we've seen rating actions being actually lower down the rating order. So wanted to get a sense from you, one, do we see a similar trend as what we just spoke about in terms of manufacturing and service corporates, the transmission of the rating actions lower down the curve, and hence we are seeing more upgrades in rating categories of A and below. And wanted to get a sense, do you see the credit profiles improving this year compared to last year, as while the upgrades are not high, ratings on positive directional indicators are higher, and I believe the balance sheets of the entities are probably at one of the healthiest levels.
Thanks, Arvind. So yes, as you mentioned, continuing with your last statement, the balance sheets of both banks and NBFCs and financial institutions at large are currently very healthy. If we look at the capital levels, let's say at banks, and we break that into two parts, one which is private banks and the other being public sector banks, which roughly constitute 60% of the overall banking system. For historical reasons, the 60% of the banking system, which was public sector banks, was always in want of capital for various reasons. What we've seen is that in the last 2 or 3 years, even that has become very strong. Currently, if we were to look at the tier 1 ratios, private sector banks are sitting at a healthy tier 1 of about 16%. Public sector banks have caught up in a big way, and they are sitting at about 13%. So very healthy when it comes to capital levels. Similarly, when we look at what's happening on the when we look at the NBFCs, growth for them had slowed down during COVID, which meant that leverage got controlled. Some of them even raised capital, and again, while there was funding constraints, seen over, let's say, August to September of last year till March of this year, that's again improving. So equity is coming in, leverage is fairly under control, and growth seems very healthy. So all in all, balance sheets at the moment very healthy for the sector. On your other point about the rating actions being lower down the order in A and let's say BBB categories, so that I think is pretty similar to what Prashant and then Bharat covered. Track record is building in there, and that is where we are getting more comfortable with these entities. The other bit in terms of positive outlooks versus, let's say, negative outlooks, So in one case, a positive outlook became a stable outlook. In the other, there was an entity that was put on a negative outlook. So yeah, those are far and few at the moment in comparison to the positive outlook, because the performance continues to be very strong at the sector level.
Okay. So Prashant, Bharat, and Vishal, I guess the entities which you rate probably need not be worried about availability of funding, as we heard from Karan. My next question goes to Prashant, because we did touch upon premiumization of consumption, and just wanted to get a sense. We have been talking about a K-shaped recovery uh, since the time of the COVID recovery that we have been all of us have been witnessing. Reports also suggest from RBI suggest that savings rate have come down, borrowing has gone up. So just wanted to get a sense, is this sort of a trend likely to be seen going forward? Where do you see this coming up in terms of the demand that is there? Or this is just a passing trend and you see the recovery to probably catch up in the products which probably are consumed by the the lower side of the K-shaped recovery.
Sure. No, I think premiumization is not something new. I think immediately after COVID, we have seen premium products showing a relatively better growth compared to the value product. And going forward, we believe this K-shaped recovery will continue. Again, the examples being, if you see the automobile where you have, SUVs growing faster than two-wheeler. And in fact, two-wheeler within product segment, also two-wheeler, the premium bikes like more than 1 lakh and less than 1 lakh showing a widely different and divergent growth rates. That we have seen in case of residential as well, where premium is showing better growth compared to the affordable segment. In the telecom also we are seeing that. So across the board, I think we have seen very pronounced K-shaped recovery. And in FY24, we believe that the same trend will continue. The other part here is the rationale for that, again, from the demand, if you were to just divide into again services demand versus maybe products demand. There also our view has been that services related demand will show relatively better growth compared to the goods or the goods or material demand. For a simple reason is that almost if you talk about the urban segment has shown relatively better traction compared to the rural segment purely in terms of recovery. And in urban, roughly about 60% of the entire demand is demand towards services rather than demand towards goods. So from that perspective, again, services within premium also, the services are likely to show relatively better growth compared to maybe goods. There is marginal decoupling. Immediately after COVID, we saw a robust growth on the goods side. Now I think that trend reversal is happening. More of a services related demand is picking up. And last bit again here, as we are talking about the demand, again, rural versus urban, which is the talking point. I think we remain positive on both of them. Urban, as I highlighted, again, the services are likely to pick up. Rural also, we are not. Rural demand is also picking up with a near the monsoon being relatively better off, and some of the other indicators like Manarega outgo is also reducing. So rural demand is also quite robust. So as far as the demand is concerned, the way we look at it is, focus the premium segment are likely to grow at relatively better growth compared to the value. Not to say that value products will also not grow. They will also grow, but relatively slower pace compared to premium. And again, services growing, showing more resilience compared to goods demand. And third thing is again, urban, rural, we are positive on both, but inherently, I think rural demand is exposed to the agroclimatic shocks, and therefore, if you were to take a pick, we would probably be slightly more constructive on the urban demand.
Okay, so continuing with you, Prashant, since you spoke about the kind of demand and the likely growth, and also this is to Bharat also. So maybe you can answer. I mean, Bharat can answer after Prashant. In terms of Capex, we did put out a report recently titled Indian Economy at the Cusp of New Private Capex Cycle. And we saw last year also that the investments in fixed capacity building has increased. And while probably not to the kind of expectations that were there, but now we believe that the investment is likely to take off. So which sectors are likely to see, moderate or good amount of investment? And what are the reasons for this? Is this because of capacity constraint, or is it because as you mentioned, the kind of growth that we are seeing in premium products, is that likely to be the driver for the Capex? And the associated question is about interest rates continuing to remain high. Do you see this as a constraint for Capex cycle? Because expectation on interest rates going down doesn't seem to be immediate. So will that be a dampener for putting up the Capex, and would demand be another dampener on the other side of the Capex?
Sure. No, I think historically, if you take out the historic data on the private sector capital expenditure, there are 4 to 5 sectors. Like you have power, you have iron and steel, you have automobile, you have telecom, you have cement, which together contributes roughly 40% of the total capital expenditure, and private sector itself contributes somewhere around 35 to 40% of our total gross capital formation. So from that perspective, there are only let's say 5 sectors which contributes which have a lion's share in the overall capex pie. And as we move on FY24 and first half of FY25, probably those are the sectors which will continue to contribute to our overall capex cycle. That is point number 1. This is because of, again, a new capacity addition that's what we are seeing. Just to answer to your question, for example, if you talk about cement, we are seeing decadal high capacity growth or supply growth. If you talk about telecom, there is a 5G implementation which is kind of supporting the overall capex. If you talk about power, then you have renewable capacity getting added. So all these are, so it's the incremental new capacities which are coming on books. And again, they should be a greenfield capacity expansion, because immediately after COVID, what we saw, the capex intensity reduced. But again, that was not to extent that everyone expected, because some of the brownfield expansion continued. Some of the corporates continue with their brownfield expansion, keeping greenfield on hold. So now, as we speak, I think some of the greenfield are also picking up. In fact, if you see, there are 2 trends which I would like to highlight. Yeah, I think the first part is, again, bearing these large sectors, there are also green shoots which are coming in the other sectors, like you have railways, you have electronics, you have chemicals, some of the healthcare, you have logistics. Some of these, relatively speaking, smaller sectors are also contributing to the overall. They are also showing good capex growth. So from that perspective, I believe overall capex recovery is slightly broad based rather than being restricted to those 5 sectors. And as a matter of fact, I think if you also look at the private sector data from RBI, which was recently released, I think they are also talking about the projects showing almost decadal high capex spend in FY24. So net, just to summarize, I think capex intensity is picking up. It is not restricted to the big 5 sectors. Some of the smaller sectors are, again, electronics, if we talk about, and some of the the other sectors are also getting benefited by PLI, although not to an extent. And lastly, Arvind, to your question on interest rate and the capex, I think broadly the thought process, again, to my understanding, is, again, from the capex decision depends upon 3 factors. One is demand readiness. Second is what kind of supply addition in terms of completing your capex in timely fashion. And third thing is the liquidity and funding. I think as long as these 3 things are, as we are discussing, these 3 things are moving in a positive direction, interest rate should not be a constraining factor for them to really decide on the long-term capex.
Since we are talking about rating performance, continuing with you, Prashant, how does all of this tie up into credit profiles? Do we see a constraint in the rating or the credit profile going forward, or you see that you have factored in and the kind of improvements that we've seen in, say, the leverage will take care of the current Capex cycle and not deteriorate the credit profile?
So typically, we are made aware about all these Capex plans by the corporates that we rate, and those future Capex are already baked in the rating that we are assigning. It is also a forward-looking rating, is also a forward-looking exercise. So we look forward for almost 3 to 5 year time frame and associated Capex plan and their impact on their credit profile. So I would say it is probably baked in the rating, and as we move forward we monitor something like the project progress, what are the cost overruns, and how the underlying market is performing, whether the underlying market is weakening or not. All these things we keep factoring that in the rating. But just to say that all the forward looking Capex is also baked in the rating.
Okay. Bharat, do you also echo similar sentiments as what Prashant stated in the mid-corporate space, or you
Kind of
Yeah.
similar sentiments, but if you have to categorize mid-corporates into sectors, there are probably 4 or 5 sectors which typifies a mid-corporate entity. These are textiles, sugar, EPC, auto, and steel, small-scale steel industries. So these typically typifies a mid-corporate entity. Now, if I look at it sector-wise, textiles was the sector that saw a lot of capex in FY23, predominantly for the power bit of their power bit, in the sense that they all try to cut costs by setting up their own renewable entities. That has kind of slowed down of late, while we are seeing good amount of capex in the sugar sector, where the ethanol push of the government has resulted in a lot of distilleries coming up and sugar capacity is being added up. Auto and auto ancillary is a sector that we have seen a lot of capex build up. And we've also seen some bit of capex build up in smaller healthcare and pharma sectors post the COVID space. So this is how I would probably talk about capex as far as mid-corporates are concerned. And as Prashant rightly pointed out, we do capture all these capex in our ratings, and ratings more or less are taken into account while these capex are being incurred. On the interest rates front, yes, the interest rates are being factored into the capex as well. But as Prashant rightly pointed out, interest rates do not to that extent affect our capex forecast.
Okay. So you also expect that credit profiles may remain steady unless an unexpected large capex, or if there is delay in implementing, is what is likely to constrain the credit profile.
Yeah.
Right. Okay. Now moving to, as I said, we'll hear from Karan. How is the liquidity available with the banking sector? Will mid corporates get funding? Will the cost of borrowing go up? Because if we see RBI's report, I think about 110 basis points is the transmission of the rise in interest rates compared to 157 basis points in deposits. So are the companies likely to see prolonged transmission of the higher cost, or you think this is the peak, as maybe RBS kind of paused in their monetary policy interest rate hikes? So Karan, your views on that?
So, Arvind, thanks for the question. In terms of the interest rate cycle itself, the house view is that we are almost at the peak or at the peak, right? Now, in terms of the transmission itself, now two parts to it. One is where loans are linked to the external benchmark linked rates. Now, 50% approximately of the system is linked to the EBLR rates. Because all the lending that has to happen to the retail and the SME segments has to happen on these EBLR rates, and therein the transmission is pretty quick, and it's already happened through, because as soon as the policy rate changes, the transmission pretty much happens there, very quickly. The other 50% or approximately 45% is linked to the MCLR rates, right? Now, that is where the transmission is slowly and steadily happening because the deposit repricing is one of the key components in the MCLR pricing that is extended to the corporates. Therein, already about 150 bips increase has been passed on, and as more and more repricing of deposits happens to reflect what's happening in the system, we expect some continuing tailwinds to the MCLRs there, maybe, but at a slower pace. What also needs to be noted here is that deposit growth in the system, which was tracking at about 11 odd percent for FY23, in comparison to credit growth, in the region of 16 to 17%. That gap has kind of narrowed because one, credit growth itself has come down to about 15 odd percent currently. That's where it's tracking, and deposit growth, interestingly, has picked up. And in a great way, that's also because of the INR 2000 rupee notes, which have all come back into the banking system, and they've kind of stayed back till now as deposits. The continuity of those deposits, though, will have to be monitored on an ongoing basis, because if that money gets pulled out, the deposit growth could once again slacken off, leading to pressure on deposit rates going forward, which then again would feed into MCLRs going forward.
No. So, in nutshell, do you foresee any issue in terms of availability of funding, particularly to the vulnerable sectors and the lower rated entities?
So the way to look at this is that the availability of funding will be there because banks have enough wherewithal at the moment to extend the funding. However, what is happening is that margins for them are getting squeezed at the higher end of the rating curve, right? So the triple A's and the double A's is where margins for them are getting squeezed. So they will try and maximize on the on what they can get from institutions down the rating curve. But funding on the funding side, we don't see any challenges at the moment.
Yep. I think we're running out of time. Last section will be if I can hear from each of you about what is expected for the next 6 months. Before that, Amay, if you can check with the participants if there are any questions.
Sure. If any attendee have any question, they can simply raise their hand. I give them access to talk directly instead of typing in chat box or Q&A section. So you continue, please.
Yeah. So can we start with Karan? How do you foresee? I think while you covered it in terms of positive outlook and strength of balance sheet, but quick word on or rather the last word on how do you see the rating profile change in the next 6 months, or do you think it will be steady?
So we think it will be steady to a great extent. In some cases where the performance of the entities turns out to be better than expected, we could see some of those moving ahead. And for some of those where we have put them on positive outlooks, subject to them, hitting the triggers that we have placed for them, they could lead into positive rating actions. From the sector as a whole, we think that the good times are likely to continue in the near term. The only challenges that we see are more so on the margin side, but asset quality, capital, those all continue at very healthy levels.
Okay. Vishal, your final words on how do you see the next 6 months?
So lastly, if I were to bucket it into various sectors, I think toll roads, they're doing phenomenally well, growing at almost 10 odd percent, more than 10 odd percent over the last 5 months or 6 months on a YoY basis. One thing which could probably, obviously, the toll rates are likely to be lower in the next year because of the lower inflation. However, one thing which you're watchful of is with regards to competing roads because there are many expressways which are getting commissioned. On the HAM side, we are looking at projects differently for different kind of sponsors. strong sponsors will exhibit the strength that they have been exhibiting over the last few years on the AM side. However, weaker sponsors, as Prashant also mentioned with regards to corporate ratings, where there's some amount of pressure coming on the weaker sponsors. There we are likely to see some bit of issues in terms of how projects are likely to be commissioned. We are watchful around those projects. On the airport side, I think things are picking up really well. The K-shaped recovery that Prashant talked about is also getting reflected into how people are spending at the airports. And despite the traffic just being about at pre-COVID levels, the non-aero incomes are nearly 30% more than pre-COVID. So that just exhibits in terms of how much people are spending at the airports, and that is, we are having a positive outlook and likely to see positive actions on the airport side. With regards to the renewable piece, I think solar projects are likely to continue, the benefits of project getting commissioned in a timely manner. I think one of the key things that we likely to see in the new projects which will be commissioned is the lowering or softening of the solar module prices, which will get affected. And where we saw the tariffs also going up, could see a stability or even probably slightly moving down than what we saw when it again went up. On the wind side, again, the overall Capex is likely to increase because while we had a very muted Capex on the wind side, given that we need hybrid projects for grid stability, we are likely to see more amount of wind projects getting commissioned in the upcoming 6 to 12 months.
Okay. And now to Bharat, what are your last words on how do you see the credit profile?
I think balance sheets are largely delivered right now post-COVID. On the lower end of the rating spectrum, it's a liquidity play, and availability of liquidity will determine movement in ratings. Whereas in the mid-level, the BBB's categories, I think commodity risks are a thing that has to be thought through and looked as monitorables.
Right, but you expect the rating?
I expect the ratings to be stable. Yeah.
Okay. And Prashant, your final words?
Yeah, broadly, overall on the large corporate side, it should remain stable only. Only thing is that the analysis perspective, it should become more of a bottom-up approach where there could be pockets of weakness, for example, export oriented market, especially Europe, or maybe some of the weaker pricing environment in US, especially on the healthcare side. And again, on the domestic side, also you have tier 2 real estate players. Again, textile also one of the export oriented story which can see some little bit of a pressure. So net on an overall basis, it should become it should remain stable. But again, that pocket of weakness we need to identify and adopt more of a bottom-up approach.
So as you heard from all of them, the ratings are likely to be stable. Current some good times are here to stay, but maybe moderately in terms of the rating intensity. Amay, lastly, if you can just check up for any questions from the participants. Otherwise, I think we can call it a day.
Sure. So as of now, we don't have any questions in Q&A box.
Okay. Then I guess it was an interesting discussion, the presentation, and the subsequent panelists updating about what is expected and what were the rating actions and what we expect going forward. Thanks for all of you to joining this particular webinar, and I would like to thank Prashant, Bharat, Vishal, and Karan for their time, and of course Suparna. Yeah, thank you.
Before that, before closing it, I would like to launch a poll for feedback. So I request all the participants to spare a couple of seconds to answer the questions. It will be help us to get a more update. Okay.
Thank you.
Thank you.
Thank you all the participants and speakers. Thank you. Good day, everyone. Bye.